15 in the road show.
Morning, Google really moving in on Microsoft's turf.
It's the news away from the show floor this morning.
What Congress can do to deal with those rising prices at the pump.
It's hard to find another athlete who means as much to a brand as Woods does to Nike.
Growers here in the Southwest say what they really need is an effective guest worker program.
Given how imposing the site is and its history, you don't think anybody's going to find it spooky to live here?
All right, well, you've heard what the interest rate decision means for the markets. Let's talk about what it means for your wallet now. Writer for Fortune magazine. And as we told you, the Federal Reserve has hiked interest rates as expected by 1/4 point, but indicating perhaps that a pause could be in the offering, and that is giving us a big rally on Wall Street. We've got the Dow up 176 points as we pass you off to the final and most important hour of the day. It's time for Closing Bell. You've got Maria Bartiromo at the NASDAQ and Dylan Radigan at the New York Stock Exchange.
This is a special edition of The Closing Bell, live from the New York Stock Exchange and the NASDAQ market site.
This is the final and most important hour of the trading day. Thursday afternoon, we are here where it all happens with a reaction to the latest Fed interest rate decision. Markets off to the races. I am Dylan Radigan here at the New York Stock Exchange.
And I'm at the NASDAQ today in Times Square, New York. I'm Maria Bartiromo. On top of all of the talk about interest rates, we also have a lot of ground to cover today on the technology front. Over the next 2 hours, we have a lot ahead. First up, the markets, and we are seeing a powerful rally. The bulls coming rushing in after the Federal Reserve's latest rate announcement, with stocks posting a powerful rally, financials leading the way. The Federal Reserve opting to raise rates by 1/4 point to 5.25% today. And the Fed also saying in its statement its future moves would be based on how future economic data is fitting in with its growth forecasts. The NASDAQ higher right now, along with the Dow Jones Industrial Average, 2% higher, Dylan.
And Maria, the Fed also noting that inflation risks remain as growth moderates. That the grand debate on Wall Street, of course, the inflation hawks not winning today's battle. In fact, the market's off to the races. They do believe that inflation is under control. Steve Leisman will join us in a moment with some of the highlights from the Fed's statement. Some key distinctions, Maria, between last month's statement or May's statement and this month's statement. Meantime, back to investor reaction. Maria told you about it. Markets off to the races. Dow Jones Industrial Average. Look at the action after the Fed decision. 1.6% in the Dow. S&P 500, same story. Again, more than doubling its advance on news of the Fed decision. Our team covering the market's reaction for you. New York Stock Exchange, Chicago Merc, and NASDAQ and NYMEX all covered. First to Bob Pisani, our eye on the floor here at the exchange. Bob.
Dylan, let's call it covering shorts. That's what's really going on here. Look, you can read all the tea leaves you want on the Federal Reserve. The bottom line for stock traders down here is very simple. The Fed remains data dependent. That's the key thing. There's only 2 facts that the stock traders know about and care about. The first fact is that going into the rally yesterday, traders were short and they had very high cash levels. The second fact they know is it's been a lousy quarter, and the quarter is ending in a day and a half. How lousy is it? Going into the rally yesterday, look at the Vanguard Total Stock Market Index. That's the whole market, down 5.1% on the quarter. That's bad. Look at Legg Mason Value Trust. That's the big one with Bill Miller, down about 8%. That's terrible, and most of the funds are like that. I don't care if you're a hedge fund or not. So what do we know? We know a lot of people have lost a lot of money this quarter. We know, number 2, we're getting a modest rally in the last day and a half of the quarter, and we know, number 3, that the Fed is at least not aggressively hawkish. What do? Duh! You buy them into the quarter, and that's what's going on here. That's what this is all about, the confluence of the Fed and the end of the quarter and a lousy quarter. What's rallying the most since 2 o'clock? Here it is. Semiconductors, builders, brokers, and emerging markets. Hey, folks, what's had the toughest time this quarter? Semiconductors, builders, brokers, and emerging markets. You doubt me? Take a look at the emerging market index, the EEM. This thing's been beaten up very badly. Went way up this quarter, then got beaten up way down. Huge volume in the last hour here. It's done 9 million shares. Normally it does 6 million in a typical day. It's had a nice move to the upside overall here. That's the key here. They're trying to pull out and buy some stocks at the bottom and pull up some of the winners here overall. Let's go over to Rick Santelli. He's standing by over in Chicago. Rick?
Yeah, who am I after?
Rick, let's go over to you in Chicago.
Hi. Well, I'm sorry we got our lines crossed. You know, it's been a wild day, and while we're talking, let's look at intradays of 2s, 3s, 5s, 10s, and 30s. Why? Because every maturity indeed had a big knee-jerk reaction, but the short maturities held on to them more. Now remember, short maturities are really more tied to the Fed. Long maturities are driven by market forces. A 10-year note at 5.20 is about where it was before the rate hike. A 30-year bond at 5.25 is about where it was before the rate hike. Short maturities are where the action's at. Fed fund futures, as they walk out, tremendous rallies. And don't be fooled and look at the really far back months, because you can't have a meeting in November before you have a meeting in August. So if you look at August, you look at September, those are the big ones right now, and they are discounting quickly a lot of the tightening. To be sure, they're still better than a 50% chance in August, but it's well off its best levels in terms of percentages, from over 80 to under 70, and at this point, it could be a lot different tomorrow, because nothing is painted in indelible ink when it comes to trading. Maria, back to you.
All right, Rick, thanks so much. And I'm now right here back at the NASDAQ with Cnbc Scott Wapner. He's here at the wall. And Scott, I called a couple of trading desks earlier, and basically the word that I was getting was that the word is out along trading desks that we might actually see that pause that people were waiting for maybe in August. And that's what we're seeing here in
I think you can tell that by looking at the intraday chart, because you can see right here where the Fed hiked rates, you had the market popped, then it pulled back a little bit. But maybe right here, when it went back up, is that conviction you're talking about, that people think that maybe we will pause during the next cycle. And let's also take a look at what the NASDAQ has done in a 2-month chart since the last time that the Fed moved interest rates. You can see it's been a tough go of it. Since that May 10th meeting, it's been a jagged edge all the way down here as the market has really struggled to get some conviction and to get some footing. As we mentioned, there's a lot of green on the board today, but let's talk about a couple of stocks that are in the red, because that's where the news is on these stocks. Teva Pharmaceuticals is down 4%. Pfizer saying that it is going to make a generic version, a cheaper generic version of its own antidepressant Zoloft. Well, Teva also has a version of that. The thought here is that Pfizer will undercut the price of Teva's drug there, and that's why this stock is down by 4%. Let's also take a look at Red Hat, because this has been a stock that started lower after the close yesterday, continued in the pre-market, and then has been down all day, now down by 8% because Red Hat is first quarter revenues missed expectations in at 7 cents a share. The street was looking for earnings of 9 cents. The CEO on Cnbc this morning said he believes the sell-off from the earnings report was based on confusion with the expensing of stock option. That's all from here. Let's go to Sharon Epperson at the NYMEX. Hey, Sharon.
Hey, Scott. Well, the rally in crude started yesterday after that weekly.
Talking about the Federal Reserve boosting rates by 0.25% today. However, the statement out of the Fed today opened a lot of eyes on Wall Street. CNBC senior economics reporter Steve Leisman now with more on today's focus on the Fed, and really the statement is what we're looking at there. Steve.
Yes, Maria, eyes wide open. The early commentary from economists. This is being seen as more dovish for the Fed than had been anticipated, because it injects some balance into the outlook. Yes, the Fed is concerned about inflation, but it's also concerned, we learned today, a little bit more about growth prospects. Up till now, a lot of the Fed talk has emphasized just the inflation problem. The Fed downgraded the economy from saying it's likely to moderate to saying it actually has moderated. All this adds up to one incremental step away from an automatic hike in August. No more Mr. Automatic, and puts on the table a possible pause, although the Fed warned about inflation and kept the option open of a hike. The key to the statement, a slight step back in the Fed's assessment of whether more interest rate tightening is needed. Here's the key to the new wording. The Fed said in the statement, although the moderation in the growth of aggregate demand should help to limit inflation pressures over time, the committee judges that some inflation risks remain. Okay, that sounds all right. But now they're saying the extent and timing of any additional firming that may be needed, remember that, to address these risks will depend on the evolution for the outlook for both inflation and economic growth. That differed slightly from the May statement when the Fed said the following. The committee judges that some further policy firming may yet be needed to address inflation risk. That's a clear signal. They think they need to do more. This time, a little bit less of a clear signal. What happens now? Well, we listen carefully to Fed Chairman Ben Bernanke's congressional testimony July 19th. We watch the incoming inflation and jobs data. Watch out for that. It could come in stronger than expected. Most of all, now we hear again from the other side, the greenback vigilantes who have sold off the dollar anytime it perceives the Fed as dovish, and the economists who are worried that the Fed is losing inflation-fighting credibility. Dylan, we're going to go back through the arguments all over again. It looks to me like the doves won a little bit of a victory here. What does that mean? remain, it means the hawks are going to be out in full force. If they're not already, they will be by this time tomorrow morning.
Real quick, Steve, you can see it now. We've had a lot of volatility on the data on perception up to this meeting. The stage you just set suggests we're going to get more, not less, over the next couple of months. True or false?
Buy the VIX, baby. I think that's got to be the way to go, because if we are, excuse me here, Dylan, if we're in a situation where we're going to be data dependent, where the Fed is not clear what it said it's going to do, it's going to be up and down on the data, and I think in a way this is what the world is going to be like with no pre-commitment from the Federal Reserve.
Yeah, trader's market here. Lots to talk about regarding the rate decision. Thank you, Steve. Joining us here at the exchange, the venerable Roger Kubarak, Senior Economic Advisor at HVB America.
Tony Crescenzi, he's Chief Bond Market Strategist at Miller Tabak and Company. Tony, give me your sense of what went on today. Obviously, the market's really expecting that maybe we will see a pause in August, or maybe they're getting more comfortable with Ben Bernanke. What do you think?
That's one of the keys. I mean, we weren't as comfortable with Bernanke in the first couple of statements that we had from him. This is the third meeting for Bernanke.
Right.
He seems to have found the right balance, whereas, let's say, for example, on May 10th, Federal Reserve said that they thought that core inflation hadn't picked up much. Here they're saying it's elevated because it has picked up. The market had felt that back in April, May, but the Fed wasn't admitting to it. So I think there's a little bit of bravado here that's important. The Fed chairman seems to be wearing the Fed chairman's clothing a little bit more comfortably now. Right. And I think that's very important in terms of giving him the flexibility to do what he wants based on the incoming data. So the market's responding not just to the statement in its particulars, but how the chairman's behaving.
But give me that comment that you just showed me in today's statement from the Fed versus what we saw in the statement the last time around. What you really heard. I thought that was real interesting.
In May, it's clear the Fed thought that the economy growth was likely to moderate. Here, the Fed said that economic growth is moderating. If we get additional evidence that it is moderating, in fact, it could cause the Fed to stand aside, maybe to not raise rates in August or perhaps September. But if the economy is moderating now, any more of that will be a great reason to stop.
But the interesting thing, Tony, in your analysis, is that it's still debatable, and yet the market today had a very distinct conclusion. It stopped debating. They bought this market today, Roger, on a belief that the Fed is done, will be done. Do you think that the market has overestimated this current Fed, this most recent Fed statement, considering Tony's characterization?
Look, this Fed would have already paused had we not had the very conspicuous increase in core CPI readings in the last 2 or 3 reports. And basically, they're telling us if we get those same kinds of readings that put us above our comfort zone, we're going to tighten some more. So basically, this decision is open, and it depends on what the next couple of inflation data points show.
Maria, what does Tony think about that inflation data then? In other words, if we're still going to be on that inflation watch for the summer,
right?
Where are we?
Well, you know, it's interesting because we were just saying that it's really is data dependent, and that's why the Fed has opened the door to this flexibility that it's been looking for.
And absolutely, one important thing is there are three major inflation numbers between now and August 8th. One of them will be delivered Friday. There are 2 deflators, as they call them, the Fed's most favored inflation gauge. One is due out tomorrow, and one CPI. So these are important in terms of deciphering what will happen next. But remember, this statement, one of the keys to this rally in the stock market, is the Fed reassuring that factors are now in place that should limit the elevation of inflation that the Fed mentioned in the statement.
Let me ask you, Roger, what you think is most important in terms of all the reports that we are getting out. I mean, Steve mentioned the jobs report. He mentioned the inflation data. What do you think is the most important piece of data that the markets will be reacting to in the next, say, month or so?
If you start seeing housing prices on a year-over-year basis fall, that's going to have a very powerful effect not only on your headlines and every other media, it's going to have a powerful effect on the Fed. So they will not only be looking at core CPI, they're going to be looking at the housing market data, which they themselves say is weakening. And, you know, our research shows 25% of job gains in the last 3 years come indirectly or directly from housing. So that's clearly the key to the economic outlook, to the growth outlook, and also important for the inflation side.
Is there any debate in either of your mind, I'll start with you, Tony, that the one thing you can rest assured of is we're going to see more big gyrations like we have endured for the past 6 weeks?
Well, keep in mind, though, and one of the big reasons for this rally in the stock market is there had been a buildup of negative sentiment. In the bond market, which, of course, some of those investors play in the stock market, the sentiment had become very extreme. For 9 days straight, the 10-year yield had increased. That was the most since 1974, before a lot of our viewers were even born. And plus, there are record short positions held in a lot of short-term securities, like the 2-year note, Eurodollar contracts, Fed fund contracts. I can go on and on. This sentiment will allow the market to be a little more stable in the weeks ahead. And now also because we have a Fed that's righted itself, I think it's found its footing.
Well, I think also there were fears that the Fed might act more aggressively and raise rates 50 basis points and basically say, we know more than the market does about inflation and the outlook's bad. They didn't do that, and that in itself is a reassuring aspect of this decision. And they just said that there were some inflation risks. They could have qualified that in a much tougher way. So this is a softer statement, and they did not do the 50 basis points. Why shouldn't the stocks rally?
If you were to look, Maria, in your conversation with Tony particularly, at the dynamic of July, it's a month historically that has a big tech rally, also has a lot of volatility in it. I'm curious both in your conversation with Tony and also Roger here, whether we're expecting a similar year this summer or whether there'll be a divergence of some kind.
Well, you know, it's been a tough ride for the tech stocks. We know that. We're covering that here at the NASDAQ, and we're going to have a lot more on that later on. I think it really depends on the vibrancy of the business sector and whether or not we see budgets increasing and whether or not we see the actual spend increases happening as a lot of people are expecting on IT and on technology. Look, there's a lot of feeling out there that the consumer is going to slow down in the second half of the year. Agree, Tony?
Absolutely.
Okay, but let's not say that that is across the board in the economy. We have to remember that the business sector right now is quite vibrant.
In fact, new data today with the GDP revision for the first quarter, corporate profits ran at over 20% pace over a year ago, up 12% for the quarter over the previous quarter, revised up by 4 percentage points. Corporate profits, as they stand in relation to business spending, near 50-year high. There's an enormous amount of cash available to spend on technology equipment and so forth.
Right.
So we'd expect the outlook to be good so long as personal spending doesn't weaken too much.
Right. So you have to believe, Dylan, that that's a positive for tech stocks at some point, but we have to see the evidence of that spend on IT increase.
And the historical data that sticks in my mind, Roger, is the early July data. If you look at the historical performance of the NASDAQ relative to the S&P the first couple weeks of July, it has better outperformance there. I know it's voodoo and this and that, but historically it does very well in the beginning of the next month. Would you anticipate that this year?
The big thing is that U.S. corporations are making mountains of profits. That was in today's GDP report, and the Fed asks itself, are we restrictive or is the system restrictive? And they see these kinds of profit reports and they have to feel there's plenty of ammunition to grow.
Absolutely, but you know this as well as anybody, Roger. The problem has not been profit growth. We've had 16 straight quarters of 10% or better profit growth. The problem has been all this cash is coming in, but investment has been limited. There's this concern about trapped capital. Why is it not streaming back out? Why is hiring not more aggressive? Why is CapEx, capital expenditures, not more aggressive?
I think CEOs believe that that's what they get paid for, being cautious, hiring with more prudence, investing with more prudence, making the whole thing last
But my point
longer.
is that profit generation doesn't ultimately yield itself across the economy into investors unless it gets pushed back into the cycle.
It's the ammunition to do so, and it is an antidote to Fed restraint to have a lot of corporate liquidity already there.
All right, Tony Crescenzi, thank you very much. Obviously,
thank you.
Roger, Kubarek, venerable. They call you that around the office?
Only you, Dylan.
All right, a major setback for Microsoft. Jim Goldman on that.
Dylan, we're just getting news now. It's coming over as an alert that Microsoft apparently will be delaying the general release of its Office 2007 program to, quote, early 2007 from what had been later this year. Autumn, in fact, was the planned release later this year, as late as January, some had said and some had anticipated. But this sort of nebulous release date now and a strong indication of a delay is the latest significant problem for Microsoft. You'll remember that the company has already announced a delay with its Vista operating system, but this is just yet another major fly in the ointment for this company as it tries to get new products out the door. This is a huge revenue generator for Microsoft. We're trying to get some details now on just exactly how long this delay will be, whether it's across the board, just for business customers or consumers as well. But again, the headline now is that Office joins Vista from Microsoft now as another major product that will be delayed. Dylan, back to you.
And watching the Microsoft stock, they're benefiting from the Fed rally, giving half of its advance on the back of that Fed rally back on the news that Jim just reported to you. Another delay at Microsoft. 40 minutes to wrap up the trading day. Dow Jones Industrial Average. A winner if you're a bull. 186 the advance on the Dow. The NASDAQ off to the races too here. More than 50 points the advance. Maria.
Meanwhile, it has been a rough ride for technology stocks. We're coming to you from the NASDAQ today. Apple is at an 8-month low. eBay is near a 1-year low. We're talking about whether now is the time to get in tech or if this sector has yet to bottom. On that Microsoft news, a lot happening in tech.
And with the Fed raising rates once again, what's Wall Street saying about the overall investment picture? We're going to ask two strategists a little bit later.
Plus, after the bell, our special report, heavy metals. That's certainly been one of the places to be to make money. We're going to bring you that special report, heavy metals, later on in the second hour of the closing bell. Then small town America reaping the rewards of that commodities boom. Now corporate America taking notice. See how Wall Street is profiting from Main Street.
First, though, the most active names right here at the New York Stock Exchange. Thursday afternoon, the Fed raised rates but left the door open to not raise them again. Market likes that. Nortel, Ford, Tenet, the Japanese ETF. Boy, they love to trade that thing. In the 4-hole today, and then EMC Corporation as the Dow's up 186. You are watching CNBC. We are first in business worldwide.
Street, coffee, bagels, and Squawk Box. Wake up and smell the money. Squawk Box. Weekdays only on CNBC.
Hi, everybody. Welcome back to our special edition of the Closing Bell today. We're coming to you live from the NASDAQ market site. Right behind me, Times Square, New York City. Lots of attention today on Washington, though. The Federal Reserve decision on interest rate. It is also, however, a big day for technology stocks. The NASDAQ composite finally showing signs of life today, adding more than 2% right now on the heels of the Federal Reserve hiking interest rates and some expectation that perhaps we could see a pause in August. Right now, the NASDAQ is higher by 2.5%, but even with this session's gains, the NASDAQ is down 2% year to date. Joining me now to talk tech, David Garrity, Director of Research at Dinosaur Securities. Nice to have you with us, David.
Thank you, Maria.
You know, earlier when we were going to the break, we looked at Apple at an 8-month low. We looked at eBay at a 1-year low. Microsoft having more news today of delays. What is going on in technology?
I think certainly right now you're seeing a division between cyclical growth and secular growth. And what it really boils down to when you're looking at Microsoft is the issue of product. They've also, with the acquisition of Skype, have moved into the area of voice over IP telephony, again, where you're seeing consumers who are trying to grapple with phone bills that could be $100 to $200. Obviously, voice over IP telephony very attractive.
So is the decline we saw in eBay, is that overdone, do you think? Are any of these declines overdone? Are you looking at these sell-offs as perhaps a buying opportunity right now?
Yeah, the fear in eBay was basically what's going to happen when Google comes out with their own sort of online payment mechanism. And Google Checkout doesn't seem to have the same level of functionality, doesn't pose a threat towards PayPal. Right. We think the concerns here are overdone. We think that eBay should be able to sustain a 27% earnings growth rate. We think that currently right now it's selling at 1x its growth rate, very low historically. We think the stock's worth 51 over the next 12 months.
All right, you got to believe 27% growth in earnings is a good number, David.
It's something to pay for.
Good to have you with us. Thanks so much, David Garrity. Dylan.
Well, Maria, some news in the gaming sector. International Game Jones Industrial Average pushing for a 200-point advance. Not only is it holding on, Maria, to the Fed-based gains, it is now extending them. Same story for the NASDAQ, where you find yourself, in fact, more than 50 points.
Absolutely. The Federal Reserve raising interest rates another quarter point today. Up next, we're taking a look at the impact on the dollar and how currency investors can cash in. That's next.
And then we're headed over to the J. Crew Post here at the exchange. See how that red-hot stock is trading today, along with today's top IPO, Avitine. It's a renewable energy stock.
But first, take a look at where the action is on the street today. The most heavily traded stocks at the NASDAQ right now include, there they are, JDS Uniphase, usually not on that list. You're watching The Closing Bell on CNBC, first in business worldwide. Thank you. I will keep it.
School is back in session. Kramer
Day.
CNBC invites you to be part of our audience for a series of survival guide specials. Thursdays, live from CNBC Global Headquarters in Englewood Cliffs, New Jersey. Call or email to be a guest of CNBC. It's your chance to ask the experts questions on the hottest topics moving the markets and your money. You're watching a special edition of The Closing Bell, live from NASDAQ and the New York Stock Exchange.
Today in our Street Smart segment, a closer look at today's Fed decision on the dollar and the outlook for the global currency market. Joining us here at the New York Stock Exchange, Michael Trade higher, 202 points now on the Dow Jones Industrial Average. Maria.
All right, thanks very much. Coming up next, right here at the NASDAQ, we will be introducing a new way you can get a jump in on the trading action, and you can see it only here on CNBC. That is coming up in a moment.
And then later, the president of British Telecom International going to tell us about the future investments he's looking to make here in the States. Learn why his company can benefit from the warrantless wiretapping controversy that's affecting Verizon and AT&T.
But first, take a look at the biggest percentage gainers here at the NASDAQ. You are watching our special market coverage on this Fed Day. We're back in a minute with more Closing Bell.
Next, BlackBerry's battle. From a nationwide service problem to increased competition. Earnings from RIM and rival Palm after the bell. Closing Bell next at 4 Eastern.
Hi, everybody. Welcome back to the Closing Bell here in Times Square, New York City on this special Federal Reserve coverage and market coverage.
Hi, Maria. I'm Dylan here at the New York Stock Exchange. Latest Fed rate decision is in the bag. Let's see how the markets take the news. It is good across the board if you are a bull. Dow Jones Industrial Average, good for 207. The belief here is that the Fed may well be done. Not that they are definitely done, but that it is quite possible that they are done if the data supports it over the next month and a half. NASDAQ trading the same way. You can see we're off to the races where Maria is, 2.7% there in the S&P 500 with a nice basket of New York Stock Exchange and NASDAQ names all together, good for 2% this afternoon.
And lots of attention on the Fed today, of course, and quite possibly more attention on where stocks head next. Some market the boost from earnings, but that may depend on whether earnings can deliver double-digit growth seen over the last 16 quarters. Joining me now to talk stock strategy, Tom McManus, Chief Investment Strategist with Bank of America Securities, and Tobias Lefkovich, Chief U.S. Equity Strategist with Citigroup Investment Research. Gentlemen, nice to have you with us as always.
Nice to see you.
First, real quick comment on the Federal Reserve action today. Big market rally. What's behind it? Tom.
Well, I think that there's been a lot of short base that's been built. A lot of puts have been bought at high prices. It's the last, practically the last day of the quarter. So I think that there's a relief rally going on right now because the Fed didn't come out in a very aggressive way about inflation.
Is that the way you see it, Tobias?
I see it as kind of anticlimactic. They did what they said they were going to do. There was nothing really incrementally hawkish in there. And in fact, they took out some of the wording that might have been perceived as more hawkish.
Do you think we get a pause in August? Or it's all data dependent?
I heard someone say it's data dependent. Of course, if the data supports it, we'll get a pause in August. But I don't think the data will support it. If they do pause in August, I think there's a good likelihood they'll come back and have to tighten in September.
All right, let me ask you about your stock strategy right now. Tom and Tobias, you both have 60% asset allocation. So you're recommending people have 60% of their money in stocks. Yet, Tobias, you have 35% allocated to bonds with 5% in cash. Tom, you're equal on both cash and bonds. Tobias, why so low on cash right now?
Well, we think that the Fed's probably getting close to the latter stages of this. The bond market's already recognizing it and has been much more benign about this inflation fear than I think many of the pundits have been. And in that context, you really don't have to. It's more of a barbell strategy here, but bonds still look like an okay level. At 5 1/4, it's not that bad.
But frankly, if I'm going to have a safer situation where I'm getting 5% looks pretty good.
For 10 years, overbuying it for the next 30 days, that may change.
Yeah.
Bonds are one of the things that cash has outperformed over the past 2 years, right? So, and our entire bond exposure, things are strong, but they're
service, et cetera. That's been where the excitement's been. But, you know, if you look back 7 years ago, you should have been buying small caps. They were sitting at 2 standard deviations below their historical PE relative to large caps. 95% probability they were cheap. Today, it's the exact reverse. And people were still caught up, and I still think they are caught up.
It probably isn't happening today because today is such a broad, short covering rally. But my guess is you're going to see this trend continue, and that as the Fed is perceived to gain traction against these inflation expectations, you're going to see a lot of the stocks that did well earlier this year underperform the S&P 500.
And you've got the heaviest. Much Tom McManus, Tobias Lefkovich, and we've got we are in the final stretch of trading right here, and the market is holding on to a pretty good rally. 15 minutes before the closing bell sounds, Dow Industrial is holding on to a triple-digit move, and the NASDAQ also higher by 2.5%. After the bell tonight, hedge fund heat. CNBC's Charlie Gasparino looking at the impact of testimony from a so-called SEC whistleblower. Should it spark an even more intense investigation?
And tonight at 8 p.m., it is CNBC's Survival Guide. The market is up today, but 2 days ago it's down, it's sideways. What are you supposed to do out there? CNBC and the biggest hitters on the street breaking down the market to steer you through the mayhem and strengthen your portfolio tonight live at 8 p.m. Welcome back to the floor of the New York Stock Exchange. If you look up here, you can see a lot of the brains, a lot of the new computers that are here on the floor just were here, so I figured I'd show it to you on a day that has the market very robust for the bulls. Again, expectations that the Fed could well be done. At the very least, they're data dependent. First time the market has truly felt that way in years, and so we are off to the races. I'm standing at the J. Crew post. A mob scene here yesterday. If you're watching, you saw it was a huge IPO, more than 20% gain in the first day. Picks up a little bit today, 82 cents right now. You can take a look at the stock for yourself. And then there's actually some more news in the IPO market today. Ethanol producer. You remember there's already been an ethanol IPO. This is the second one in that generation. This one's called Aventine. It's a renewable energy. It's an ethanol stock. Price is IPO $43 a share. Right now, stock under some pressure, down nearly 9%. Particularly interesting considering how much the market is up today and how its predecessor traded. A reversal of fortune of sorts compared certainly to J. Crew and the other ethanol names out there. Very interesting to see that today, in fact. And speaking of ethanol, after the bell, CNBC's Spill the Beau going to take a look at Ford's new push into embracing the alternative fuel source. So ethanol not entirely a sure thing, and this IPO proving that today as we've got a few more minutes here to wrap things up. Dow Jones Industrial Average, NASDAQ very much holding on to those gains. Maria.
Well, the NASDAQ is debuting new technology. It says we'll give investors a full picture of the trading action. You'll see it here first, next.
And now online, Jim Jubak, columnist for us here, talking about Anadarko's big acquisitions and what they can teach us about the energy sector, all that plus news and portfolio tools at CNBC.com. That's on MSN.
And as we head into a break, take a look at a snapshot of today's biggest decliners at the NASDAQ. We're coming right back with the closing bell.
You're watching a special edition of The Closing Bell, live from NASDAQ and the New York Stock Exchange.
Well, we've got less than 10 minutes left in the trading day on Wall Street. How would you like an advance indication of where a certain stock is going to close? Pretty nice, huh? The NASDAQ tonight rolling out new technology that it says does just that. It is called the Closing Cross. Joining us now to explain it is John Jacobs. He's Executive Vice President of NASDAQ. And he's with our own Scott Wapner, ready to walk the wall with the new technology. Welcome.
That's right, Maria, and it's an exclusive look at the technology that NASDAQ said is going to take investors really deep inside the action. As you mentioned, it's called the Closing Cross. And John, I put Microsoft up here because we had some late-breaking news on Microsoft with the delay of the software. So what exactly are we looking at, and how does this work?
Okay, Scott, let me walk you through it. This is the NASDAQ Closing Cross, and this is a view of it that's never been seen before. Every stock market, including NASDAQ, always shows you the current price. That is the price right now. Those are the trades that are occurring between buyers and sellers. What's new about this, which happens the last 10 minutes of every trading day, is this indicative price and the paired shares and the order imbalance. And let me walk through that for you. Starting every day at 3:30, we start accepting orders from investors for orders they want executed at the close, especially on a day like Russell Rebalance tomorrow. That's where it's so important. We take those orders from 3:30 to 3:50. At 3:50, we start pairing those orders up. We start running an auction, a very advanced, sophisticated electronic auction, to find where do those prices meet. So right now, for example, we see that there are 611,000 or 612,066 paired shares in Microsoft at this price. And as we get closer to 4 o'clock, they're going to keep running that to find more and more paired shares. What price will execute the most?
Right now, we have a buy imbalance of almost 60,000 shares. That means that there's more buyers out there for Microsoft than there are sellers at this moment.
Distinguished guests here to NASDAQ. We're delighted to have you all here to officially ring the NASDAQ closing bell. Hannah Bios.
Well, as you can see, we had a nice demonstration, and then they were giving a little speech there. So you got to listen to the speech, too, over at the NASDAQ. See, it's a full-service broadcast this afternoon. You want full service? Here's what you need to know. The Federal Reserve raised rates. That was widely expected. Most importantly, the statement left room in the forward-going analysis to stop. Market loves that if you're a bull. Dow right now good for 216. S&P moving more than, where's the S&P here? More than 24 points. Maria. NASDAQ more than 50. Maria.
All right, Dylan, thanks so much. We are watching tech as we're approaching the close on Wall Street. Don't go away. We'll be back with the closing countdown next.
Trade.
Welcome back to the floor of the New York Stock Exchange. Bob Pisani has our eye on the floor. A great day for the bulls.
Yeah, look, what is going on here is the Fed is now providing cover for an end of the quarter rally. Remember what happened yesterday. Going in, the end of the market, Tuesday at the close, horrible quarter. Most funds I've talked to, and I don't care if it's mutual or hedge funds, down 4 to 9% at the close on Tuesday. All of a sudden Wednesday, get a little move up in the middle of the day. Dow's up 50 points. Not a lot, but you look around. Then you come into the morning, normally a flat day on the day of the Fed. All of a sudden, market's up 100 points. Now you got a 150-point rally suddenly going on ahead of a Fed meeting at the end of the quarter. People are having a lousy quarter. They're saying, good heavens, I could improve my performance a little if I get in, but I'm afraid to get in because the Fed could blow me up. The Fed comes out with a statement that's at least not aggressive. At least not aggressive in terms of the fact they're going to keep raising interest. A little more benign. Now you got the cover to move in, and that's really what's going on here. Believe me, the end of the quarter is really what's providing a lot of the juice to going on here, not just what the Federal Reserve
Which means what going not only into tomorrow's trade, but into next week.
Okay, now you got a little bit of a problem because now this is going to be over very quickly, this whole trade in the next 24 hours. Now you're going to be dependent on earnings data. You better have some decent data to back it up, or very quickly they're going to start putting the shorts on again.
Quarter ends on Friday.
That's right.
Interesting point. We have had almost no pre-announcements, no warnings that I can think of up to this point.
And look what happened to Advanced Auto Parts when they came out today. They were the one today that specifically said, our clients are having a harder time because of higher oil, higher credit card rates. Of course, they have a certain kind of clientele. They made very clear, low and moderate income people. They made that clear in their statement. But look at them, they were down $6.
But how do we interpret a quarter in general where we've heard basically nothing from any significant company about an earnings disappointment going into the quarter?
So far, nothing is good. Not hearing a lot is good. But remember now, we've got this nice little rally. They'll put the shorts on really fast if we don't get some data to support the idea that things are not at least holding up fine, if not doing better than people had thought. Look what happened to the emerging markets index today. It was down, what, 6, 7, 8, 9% on the quarter? All of a sudden, it's up 4% today, 4.5% on huge volume. The minute that those notes from the Fed came out, people are trying to get in on stocks that they think are bottoming out at this point. That's what's going on.
Are the names that are flipping that reverse the ones that are most vulnerable to the decline if we don't get the data you're talking about?
Yes, absolutely. I mean, look what moved up nicely today. Brokerage stock hurt bad this quarter. Semis hurt bad. They had nice little rallies right in the middle of the day. In fact, they outperformed the overall market. If we don't get something to back it up, they'll have the same kind of thing.
We're doing the closing bell. Dow and NASDAQ are winners. Second half of the closing bell. Setting up for you begins with a special here. Maria Bartiromo.
Hey, Robert.
At the NASDAQ market site.
Thanks, Dylan. The Fed and the markets are at a crossroads, and we're at the crossroads of the world. Times Square and the NASDAQ. The second hour of the closing bell begins now.
Live from the NASDAQ market site in Times Square, this is a special edition of the Closing Bell. Here now, Maria Bartiromo.
And hello, everybody. Good afternoon from the heart of the financial capital of the world, right in the middle of New York City, at one of the most powerful exchanges in the world, the NASDAQ. It is Federal Reserve Day, and what better way to gauge the impact of the Fed's latest move than to be in the middle of the action here at the NASDAQ market site. Good to have you all with us. Stocks across the board skyrocketing today on Wall Street. The Dow Jones Industrial Average up more than 200 points, the biggest point gain since March of 2003, and the biggest percentage move since April of 2005. And it was all fueled by renewed hopes that the Federal Reserve will perhaps pause at the next Fed meeting in August. It is widely expected today the central bank did raise short-term interest rates again by 1/4 percentage point to 5.25%. It is the FOMC's 17th consecutive hike in rates since June of 2004. Check out the reaction on Wall Street. All 30 stocks in the Dow today positive. The last time the industrial average gained more than 200 points was back in April of 2005. And there's the chart. Right after the news came out, the market soared. The NASDAQ gaining more than 2.5%. Again, similar chart pattern there. We got the news at 2:15 p.m. Eastern Time. and the market went up. S&P 500 moving back into positive territory for 2006. We've got all the bases covered today on Wall Street. Bob Pisani at the big board, Rick Santelli in Chicago at the Merck, market strategist Tony Dwyer, Jim Bianco, and economist Brian Westbury. Let's kick it off down on Wall Street with Bob Pisani, our eye on the floor of the New York Stock Exchange. Robert.
Hello, Maria. What a team you've got assembled there. Hey, folks, the market internals are even better than the Dow would indicate. Much more volume went into stocks that were moving up than were declining. That's a key internal indicator here. The bottom line is this. The Federal Reserve today provided the cover for a rally for the end of the quarter, and that's really what's going on here. We only know two facts stock traders know. Number one, cash levels and short levels were very high going into yesterday. Secondly, it's been a very poor quarter. Many funds down 4 to 9% on the quarter. Knowing that, the best trade at this point is to buy into the close of the quarter once the Federal Reserve gave you that kind of cover, and that's what's fueling this rally here at this point. We've had an across-the-board rally today, not just stocks moving up, bond yields moving down, the dollar has weakened on top of that. Those are the three main factors here. Is it a basis for a rally? Here's the problem. This thing ends tomorrow. Next week, we're going to have to deal with earnings guidance. There better be some positive commentary, or at the very least, benign commentary, or this little rally is going to be in a lot of trouble. Maria, back to you.
All right, Bob, thanks very much. Investors also paying close attention today to the latest economic snapshot. The government reporting that during the first quarter, the U.S. economy posted its fastest growth pickup in 3 years. Gross domestic product rising 5.6% between January and March. That was much stronger than the earlier reading and more than triple the growth of the previous quarter. Much of that upward revision due to higher corporate profits and a lower increase in imports. Another bright spot today, more benign revisions to the GDP inflation indicators. Let's get the Fed decision igniting a frenzy on the floor of the Chicago Merc today and get all the action from Rick.